Welcome, everyone, to our Trading Index Options webcast. I'm Connie Hill. Happy to be here with you today as we kind of do some fine-tuning and examine some results of our current strategy that we're testing out, seeing how it works. So happy to review that information with you here today. Happy to see so many common, familiar names out in the chat here today. And I think we may have some new folks as well. We want to welcome you to our webcast. And if you want to introduce yourself and say a hello into the chat, you are welcome to do so. This is a very friendly group, and they will welcome you with open arms. Now, I am joined in the chat by Cameron May. I'm happy Cameron's here, 20+ veteran years of the market, fellow coach. And he's here to maybe help catch some questions I can't quite get to. I'm going to keep my eye on the chat because I do want to catch your questions. But if there's something maybe a little bit different, we'll have Cameron pick some of those questions up. All right. If you're listening to this on the recorded version and you have questions, put your questions in the comments section of YouTube. I go back and look every day, see what kind of questions are out there so that you can get them answered quickly as well. Now, I hope you're following me on X, and if not, this is an invitation to you to do so. I am at Connie Hill CS. Cameron is at Cameron May CS, and we'll post educational content out in our X account throughout the day, things that we may have noticed about the market or stocks, some things that might be of interest to you. We'll go ahead and post about them. All right. Juke says you might be in the wrong class. You are not in the right class. You are in the right class. We are going to be talking about our linear regression model that we've been testing over the last few weeks. So you are definitely in the right spot. So no worries. All right, let's go through our disclosures and get into our session today. I've got a lot of ground to cover with you. What we talk about today is intended for educational and informational purposes only. Don't consider it a recommendation. Past performance is no guarantee of future results. We will be talking about European style options, which means that they are not assigned early. Many of the things you're used to trading are American style, right? Our regular stocks out in the stock market, which means they can be assigned early. When trading options at or near expiration, you have to be considerate of the different risk specifics to whatever strategy you might be trading. When we're talking about probabilities, they are theoretical in nature and are not guaranteed. We'll be using the Paper Money software application. It's provided for educational purposes. I think it's a great place to test out rules that you're interested in, or even just learning a particular strategy. Man, it's fantastic for it. If you want to be testing some of the things we're talking about in our class, yes, absolutely. It would be a good use of your Paper Money account to do so. All right. Just want to give a quick plug to upcoming events that you might be interested in. They're free to you as a Schwab client. We've got a webcast, or not a webcast, a workshop in Orlando this coming weekend. If you're near there, can get there, register now. I don't think they're full yet. I haven't heard an announcement about that. Then at the end of the month, New York will be an advanced options workshop. That's the 28th and 29th of August. And then there will be in September, Market Drive event down in Scottsdale, Arizona. That's just a one-day event. It is not the same as a workshop. We're really focusing on what's going on in the current market and maybe some ideas from various folks as far as what are they seeing in the market? What are they seeing that maybe works? Maybe some things to avoid, things of that nature. All right, Sam says the New York City event is in Midtown Manhattan, close to Times Square, so it should be fun. It should be fun. That's an excellent location for that. All right. Let's see. Sam says that you are seeking back testing of the 3 black rows, which are candlestick patterns, right? Of basically 3 bearish days in a row, or if you're looking at a different time frame. Interesting. You'll have to let us know about that, Sam, as you are progressing through your testing and back testing. All right. In this class, we are typically looking at verticals and iron condors, sometimes butterflies, and we'll talk about some hedging opportunities. We have primarily at this point been focusing on different rule structures that we could use to trade verticals, primarily because the market's been more bullish, primarily short put verticals for our bullish market. Now, out on my scratch pad that you can see here is some information about the rules or the model that we're testing right now. We have been testing two models. Model number one is using the market forecast as an indicator, and that's what's down here. We'll maybe mention it here and there, but the one we're really going to focus a lot more on is the rules down here where it says linear regression model. And I'm going to go to my chart that has our linear regression model on it, and let's talk about it here a little bit. This is a 6-month time frame. You need to be cognizant of that because how the linear regression model works is it's going to look for, in whatever your time frame is, in this case 6 months, the furthest out point. Whether the furthest out point is on the top side of the linear regression or the bottom side, doesn't really matter which one. It's just going to pick whatever one is the furthest. So in our recent time frame on SPX, the most furthest out is a date here on March 30th when it went down the lowest. Now, I've got 3 different lines on here that probably need a little bit of an explanation. Over on your studies, first bring up linear REG trend line, and then you're going to choose linear REG CH50 and then CH100. And if I type these in here, they're mostly going to be all showing by the time you get typed in linear. Oops, you got to type it with an R though. Okay, so here is the linear regression trend line. Here's the 50%, here's the 100. And let's talk about what that means. Going through the middle is this mean line. And essentially, it's trying to connect as many points in a row for the time frame that we've selected to give us kind of a median point there, which basically means kind of average, most common, that type of thing. The linear 100, then, what it's going to graph for us is that furthest out point, whether it's on the bottom side or on the top side. It'll graph that. Now, these 2 green lines here are essentially 50% of the 100. Okay, so we've got 1 green line here and 1 here, and basically they represent 50% pulling back from that 100% line. It has this low point here, but whatever that I'm going to say amount is that it is graphing here, it's just going to flip it up on the top. So there's the same distance between that median line on the top side and the same on the bottom side. And then on this green one, 50%. It's not going to go out all the way to 100%. That's that line, but it'll do 50%, okay, of that initial move. Now, if I were to change my time frame here and say I changed it to 2 years, I might have a different bottom point. Remember, I told you it was the 30th of March that we were looking at on the 6-month time frame. So that's about where my mouse is right here. But in a 2-year time frame, that low point is significantly lower. And so when you decide what time frame you want to be working with, keep it. Okay, otherwise it will change up to fit whatever the time frame is that you're looking at. So we're just going to go back here and switch our time frame back to our 6 months, 1 day linear regression. Now, the reason that we're talking about this is because somebody in the class requested it. I think they had seen a stock or a class that Cameron taught a few weeks ago about linear regression, and they thought, I wonder if it might be fitting to maybe try to do it with index options. And so that's why we're testing it out in the first place, is because one of you brought that to our attention to say, hey, could we do that? Cameron, if you wanted to throw in your class where you taught specifically about linear regression in a really detailed format, feel free to do so for any of those that might be interested. So as we look at the rules here, let's kind of discuss them. So we have the bullish entry rules, and the linear lines are going up. That means that we are looking in a bullish manner. And overall, the S&P is trending up, right? I mean, we can look at long time frames and say, even if we came out here 10 years, essentially it's trending up. And so we want to be positioned on the right side of that, meaning go bullish when the market's bullish, go bearish when the market is bearish. But primarily, it's been quite bullish. And so our expectation is that we probably get some bullish signals. And so our rule was this. We said we will take a bullish trade unless we have some bearish indications. Okay, what would be a bearish indication? Well, one could be bouncing down off the linear regression line, the trend line in the middle here, or one of these levels, the 50% level, or bouncing down off that 100% level up there at the top. Or, so that's one thing we might look for. We could also look for, or I should say, plus we said this, so this is including, maybe we are seeing a bearish candle bouncing down off of a resistance area or off of one of these linear regression lines, okay? So for a period of time, we have had some bullish trades going on, and sometimes we'll do it just in our class. Sometimes if I see that opportunity throughout the week, I'll throw in one of those trades. So from last week, let's take a look and see what was going on here. So I'm just going to kind of zoom in here a little bit closer. Last week, we met on the 29th of July, which is right here, and it was a bearish candle. That's when we met last. Well, on our rules, we really didn't have bullish entry signals. After it kind of bounced down here, it just was kind of going sideways. It wasn't looking like it was having a nice little bounce up off of either the support level or one of these linear regression lines. And so what did we do? We stayed out of the market. We did not place bullish trades. Now, after our class, looked like, oh yes, finally we're getting some bullish candles. This area here had been an area of support for a long period of time, and this is actually a slanted trend line here. And so I'm going to kind of spread this out a little bit so we can see that a little bit more detailed. All right. So somebody could have said, yeah, I think that's bullish enough on that day. It's bouncing off of that trend line, that they could have said, okay, we're going to go ahead and we're going to trade a bullish put spread. Now, the other rules that go with this are, well, what strike are you going to sell? And so we have determined we're going to go 14 days out, days to expiration. So we would be in the trade roughly, or the contract would be good for 14 days. Okay. We would sell a 17 or 18 delta or something in that range. Okay, maybe you don't have a 17 delta and you have to go down to a 16, or maybe it's a 16, 19. Okay, but we're trying to focus on 17, 18 if we can, if it's available. If not, pick one of the others. The plan is, when would we want to get out? And the plan was this: if we get 50% of our profit target, we would have an order sitting there to get out. So it does it for us automatically. We're not trying to catch it. Now, we were experimenting with, well, what if the trade doesn't go our way? What if it doesn't move that way and it ends up we are needing to be stopped out of the trade? Well, one thing we discussed last week was the idea that in this kind of a trade, and I'm going to just come out to SPX here, and I'm going to go out 14 days, okay? And if we come out right now to look, well, where is this 16 or 17 delta or 18? Let's see where they are. This is my delta column. And we actually have multiple choices here because we see a few 17s. We see two different strike prices at 18s. And we typically have been picking the one that has the most open interest. You could also include volume in there, which would be today's activity as well. And so we are simply picking an 18 or 19 delta. But let's suppose, and this is actually a position we have on right now that I put on a little earlier today. Here, for this particular spread, we're going to be selling the 75.70. And so maybe what I'll do here is come back to the monitor tab, activity and positions. And down here for a linear regression model, here is where we have that 77.50, 75.70 put spread. Initially, when we got into it, we collected 390. Okay, so a nice little, or 290 rather. So a nice little 290 credit. Right now, the value of that spread is $2.70. So we have only had about 20 cents of that initial credit kind of melted away. Okay, and ideally what we want to have happen is for it to melt away quickly. Now, if the index is moving at a swift rate, that can happen a little bit more quickly. But I want to talk here about the max gain, max loss, and knowing what we have on the line. In here, if we have a 20 wide spread and maybe that should be here. I don't know if I wrote that out here in the rules here or not. We're doing $20 wide, okay, of a spread. So $20 minus 290 gives us our maximum theoretical loss. So that's going to be in the neighborhood of what? $17.10. So we would be risking $17.10 to make 290. Now you're going to be thinking, why in the world would we do that? And the answer is because it has a high probability of success. However, we want to put a stop in place. If it turns out that it is not going our way, we don't want a max loss. We don't want anything even near a max loss. And so we had been experimenting a little bit. And we had said, okay, we could do get us out if the price of the option or the spread here gets 2 times or 3 times the initial credit. So we experimented with 3 times the initial credit. And then the trades I've been doing in the last few days have been doing 2 times the credit. Meaning if the value of this spread goes up and it's 2 times 290, which puts us just a little bit short of 600 or $6, that would be what, 580, right? If it goes against it 2 times that amount, we want to be out. So we don't want to be anything near a big max loss, although we would position size for it, okay? And make sure that we're only taking on the risk that we feel comfortable doing. All right. Now, let's see what of the rules are on here that I need to make you aware of. So my example for one trade that I had done last week is when we were practicing the 3 times, whatever the credit is, was a $1.30 in that case. And so we said, all right, we would get out with a stop if the value of that spread went up to 390. Now, ideally, in these credit spreads, we collect a premium up front, and then we want to see it decay. That's how we get to a point of locking in a certain percentage of our potential max gain. Like in this case, we've said if we get 50%, we would be happy to get out. If we get 50% of 290, great, get us out of the trade. That would be what? In the neighborhood of about $1.45. Then if it still looks like it's opportunistic to do so, if the chart still is looking bullish, we could put on another one. Okay, that could happen in the same day. It could happen after a series of days. However, one of the rules we've really stuck with is if we are still in the trade by the time we get back to our class the next week, if we're still in the trade, we're going to get out. Whether we're up a little bit or down a little bit, we're getting out. Okay. Now, we actually have not had that scenario kick in yet, meaning we haven't held a position with the linear regression model. We haven't held a position that held on until the next week of class because they're actually cycling through at a pretty decent rate. Mark says, yeah, better to use 200% with a 17 to 18 delta. So you kind of like that adjustment there. Mark says, it looks like there's currently an asymmetry between the profitable X at 50% and unprofitable X at 300% condition. Back testing shows this reduces the expectation value of the strategy. And that very well could be. Now, as I'm looking in the chat to answer your questions, I'm noticing we have a feedback survey out in the chat. Now, those of you that are veterans of our classes know that from time to time, we'll throw out a survey that we would love you to participate in, okay? It's really easy. There's 2 questions, and you just fill in the radio button according to your feelings on a scale of 1 to 10, all right? And you just go plop, plop, click on the radio button, you can be done. But we appreciate your feedback. There's also a couple questions. If you wanted to answer those questions, I love to hear your thoughts on them, as well as if there's something else you want to communicate to me. Meaning you're like, hey, I've been testing XYZ and I'm finding ABC, whatever that might be. Feel free to tell me about it because then I'll incorporate it into a future webcast. Just like what we're doing today with this linear regression model. We're testing it out because one of you was interested in trying that out. Now, I'm not saying the linear regression model is the end-all, be-all, super great. More than anything, we're testing it together as a class. Now, let me kind of give you a summarization of maybe what's happened in the last week and today. Now, today I had the opportunity to kind of watch the SPX quite a bit today, which was ideal because I wanted to have some fresh information for you today. Let's just come back to the chart. Let's just talk about what SPX has done recently. After our class last week, we've had some successive moving up. We had the SPX put in a new all-time high yesterday. Today, it put in an additional new all-time high before pulling back a little bit, okay? If we had been trying to trade this system yesterday, we had a real bullish day. We could have had many opportunities. Now, I did not have the time frame to be as attentive to it yesterday as I did today. Okay, but today, let me show you what we did. Let's go to the monitor tab. We'll come back to account statement. I've got it set for 8 days back from today because that starts our trades down here on July 29th, which we had done a trade before we got into the class. And then right before we ended our class, it actually hit our profit target. So in this case, we had a $1.30 that we brought in as a credit earlier in the day. And then maybe an hour and 15, 20 minutes before the market was due to close, it went ahead and took our profit target. Think of this, 50% of 130 would be about 65 cents. And that's what we put in. And it was nice to us. It didn't make us pay 65 cents for it. It made us pay 55 cents. Just happened to work out that way. So we got a little bit better fill than what we put in. Now, sometimes paper money will be nice to you, okay? Don't count on the live market always being as nice to you as maybe what it is in paper money, okay? Just something to be aware of. Now, Wayland says, is there a way to get out of the trade manually, or do you have to cancel the stop order you had set up in the first place? The answer is you have to do it. Yeah, you do have to do it manually. You would just come out here to your working orders. And you can see I've got some working orders right here that we'll get to in just a minute. And if you wanted to change it, yeah, just come in and overwrite it. You could either pick, we've got an OCO set up here. We have our profit target, and that if we get 200% of the credit in a loss to get out. Okay, so whichever one of these executes first, that's what you have, and it hurrying cancels the other order. So in this case, you would just come in here. We've got $1.45 in the last trade that I put on today. And so you, yeah, just come out here, do a cancel replace. And if you're just trying to sell it for the current limit order, great. Or if you want to change it to something else, yeah, that's where you do it. You could either do it with a stop or with a limit order, whatever you feel like is most appropriate for what you're doing. Okay. All right. Well, today, Mark says, when do you decide between a call or a put spread? Primarily, we are doing put spreads because the market's been more bullish. And so our bias is to the bullish side, and we're going to put on a bullish trade unless we have a good reason to not do that. Okay, unless we have some bearish signals. Okay, so let's kind of carry on with these rules right now and not get into setting everything up bearishly, because we haven't had a ton of opportunity for that yet. All right, if it turns out we're not on all-time highs anymore, market's doing a pulling back a bit, or maybe just a little bit of a correction, yeah, then we might flip the lid there and say, all right, if we have bearish signals, we will trade bearishly. Okay, but right now the default right now is on this rule number 2, take a bullish trade unless there are short-term bearish signals. Okay. Sam says here, most likely get cut off at the trade if a stop exit already is already example rejected. Not sure exactly what you mean by that, Sam. But let's carry on. So let's get out of our working orders. That was just an example to show you what the question, to answer that question. Let's come back to our account statement. So we did a few of these trades. So before today, we did about 5 trades using this new set of rules, getting out at 2% if it goes against us, or getting out if we get 50% of our max gain, just automatically. Let's go take the profit, exit. Now, every time we get into a trade and out of a trade, remember, you're going to be charged a commission. Index commissions are a little bit more than what you might be accustomed to. Well, actually, I don't know if that's true or not. We'll check it out when we do a trade. All right, so we had 10, well, I take it back. We had 5 linear regression trades. When I was putting in these trades over the last few days, I would put in for the linear regression model. And if the rules indicated to get in for our market forecast model, which we're not dissecting today, I put the order in for it as well. As a result, what happens here is you will see in some of these that one of the credits that I put on is a lot bigger than the other. The market forecast model goes further out of the money, so the credit typically is smaller than the linear regression. So I put on 5 trades using the one cancels other order. And I want you to just kind of come with me. Notice these are all limit order. Most of these are limit orders, not all of them, but most of these, as we go back up here, we're seeing are limit orders. What does that mean? It means that we are only stopped out twice, one for our linear regression model, one for our market forecast model. In this case, it was a position we had held overnight. So the 29th, and then the next day on the 30th, then first thing in the morning, right after the market opened, we got stopped out pretty quick. Okay. So what does that mean? Well, it means right now with this little limited testing, we've had 4 winners and 1 loser. Okay. Yesterday, it was a real bullish day in the market, wasn't it? And so on the 4th yesterday, I did not have the opportunity to kind of take advantage of it like I might like to, okay? Which is okay. So today I did have the opportunity. And so let me show you what happened today. Today was August. Today's August 5th. And so we put in 2 trades again. One of them is for our linear regression model. That's what the 240 credit is for. The second order here is for the market forecast order. Okay, so the one we're really focusing on here is the credit we brought in at 240. This was early in the morning. And then not very far later, in fact, it looks like it was maybe 6 minutes. It's from 7:33 to 7:39, so about 6 minutes, and both of these executed at the same time. It went and took our 50% of our potential gain. It took it, we were out of the trade. So we could, if we wanted, say, okay, that's our trade today, that's all we're going to do. But if you look at the chart and the chart is still looking bullish to you, you could put on another order. So that's exactly what we did. So here's our first orders, and then here was the buyback. On the 75.70, you can see here we brought in 240 credit. We should have got out at what? 120. It filled us a little bit better. Actually, this is a little screwy. This is saying a 90-cent credit. It should be a debit. Okay, so this is, I'm going to say, met the condition, but probably not a realistic expectation on the fill price for that order. The rest of them are looking more normal. Sometimes in the morning or the late afternoon, sometimes the price is popping all over the place. And so sometimes you might get an interesting fill because you're just getting matched up with a market order. And the market order says, just fill me at whatever the next available price is. Okay. I think it's going to be a little bit more realistic when you're trading something in your live account. If you notice a funky fill, like that one's a funky fill, that maybe isn't totally representative. Okay. However, so both of these, one was a 20-cent debit and one was this 90-cent credit. And realistically, it should have been 120 here and 90 here. Okay, so this one was right. Brought in $1.80. We said, get us out. If we can get out at 90 cents, boom, it did it. So then we sold again. 745, 747. So we're going to focus on this actually the 747 trade. We brought in 280 of credit. And this was 57 or 75.75. And 75.75 filled up here at about 806. So again, we were filled on our order pretty quickly. But what was the market doing? The market was really bullish this morning. Okay. And so if we were to come out here and say, well, let's look at let's say I'm going to change this to a 1-day 5-minute chart. Let's go 1 day. Let's go 1 day 5 minutes. And ignore the linear regression lines. It is plotting them for the whole day here. But essentially, here's the first part of the day, 7:30 when the market opens here. Man, it was just going pop, 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 pop. And so we were able to get in and out of several trades. They happened pretty quickly. Then when it started going sideways, not so much, right? Because it wasn't racing. So we were in a trade longer here. And then it started to pull back fairly significantly here. Now, the one thing that we don't have a rule for is how to determine intraday if it still looks bullish enough to get into a bullish trade. On our orders, I'm going to kind of scroll down here a little bit. Right now, we've got an order that's working right now. It hasn't moved a whole lot. We got filled at $2.30 on it, $2.30 or $230, and it has not wrapped up yet. And we got into that trade at 11:42. So then the market started to go sideways a little bit, then pull back a little bit. Okay. And so nothing much has happened since then. However, we could have got in fairly soon after that. At 8:22 is when it went and bought back and executed our 50% of our max gain, right? We see it here with 50 cents and a $1.30, and the $1.30 is related to the 20-cent credit. Yep, that's about 50%. This, the one that's 210, should have been filled at about maybe a $1.15 or something. It looks like maybe it filled at us a little bit nicer price, 130 there. All right. Is every day going to be like that? No, it's not. Every day would not necessarily have such a bullish tone. However, this happens to be in our testing today. It worked out that we did never hit our stop today. And it got to a point in the day when, as I looked at the chart, I was like, I don't feel comfortable putting on a bearish trade. When it was pulling back here, I didn't feel so comfortable with it. And so I thought, I'm going to bring in an intraday rule and test it a little bit. And we're just like barely starting to test it. I use it with a different system, but I'm going to introduce it to you. Okay. So this would be for making decisions. If you want to continue putting in a new trade, if it gets filled, put in a new trade. And so I added an extra chart here. And this extra chart has on it a 200 period moving average. That's that green line. The blue line is a 21 period moving average. And this red line is a 50 period moving average. And then down here we have an RSI. And the rule that I use with a different strategy is that if in a 1 day, 1 minute chart, which is super time sensitive, okay, if it's above all those moving averages, and if the RSI line is headed up, then we can enter into a bullish trade. But if all those conditions are not met, then we don't do it. Okay. I said, well, let me change this time frame to maybe something that is a little bit better, which is a let's come back here. 1 day, 5 minute chart. So not every single minute, but say every about 5 minutes. What we're seeing here in the blue is today's trading activity. And so I thought, well, I'm going to watch this for a period of time. And if it gets so that it gets above maybe these two moving averages, the 21 and the 50, then maybe we put on a bullish trade. But while it was trending down below those two, and I was seeing the RS line go down, it was like, okay, maybe that could be used as an intraday filter to determine, does it look bullish enough to continue trading it, or does it not look bullish enough to continue to trade it? Does that make sense? So totally a different chart, totally a new set of rules that are going to be worth testing to determine that. So it was a little bit later we were able to get into that trade. I'm thinking, trying to remember exactly when it was. In any case, the trade that we're sitting in right now qualified for a short period of time. And then you can see since then, the RSI just kind of stuttered, right? More or less equal lows, equal highs. Not really doing a whole lot there. Okay. Mark says, looks like we have another buyback marked as a credit on 8/5 at 7:39. Yeah, that's the one that I was saying, this probably isn't that realistic. Yeah. Yes, I am. My time zone is the Mountain Time Zone, so I am 2 hours behind the market. It opens at 9:30. Here it opens at 7:30. So should have mentioned that on the timestamps. All right. Now, I think it would be worth pursuing to maybe test an intraday rule to determine if we wanted to continue to pursue the pace of selling a put spread like we were doing here when the market was very bullish. Okay. Turns out our stop wasn't hit today. Again, I showed you a couple of days ago where it was hit, right? And that was holding a position overnight. So possibly, the question is, should we leave our rules alone, or do we need to tweak them a little bit? And I think the answer is we need to tweak them a little bit to know intraday, do we have a signal that make sense for getting in the trade, right? Putting it on. When it was trending bearishly below these 21 and 50-day moving average, no, that was not feeling so good. Yeah, just it wasn't. Right now on our position, let's come over and take a quick peek at it. The one we're paying attention to with our linear regression, this is the one we got 290 right now. It's at 280 and the market's just kind of been sitting fairly level. However, I do want you to notice a couple things. One is the short-term trades that we did today following that model, including the credit that we just brought in, profit-wise is about, well, now it's even. Well, it was even for a minute, about $460, $470, $480, $480, something in that range, okay? One of the trades accidentally went to this grouping up here. So it actually is a little bit better than that. I forgot to send it to its right group and didn't notice until the trade was all over. Okay, so it actually is a little bit better than that because one of those first initial trades went to the grouping up here. Okay, now some of you have inquired about 0 days to expiration trading. Could it be that we could follow something like that in that kind of a model? It could be. Okay. What we're going to do the next week is we are going to test that intraday moving averages. Do I think these are the best ones to use? I don't know. We'll have to test them and see. Could we use different moving averages? Absolutely. You might say, Connie, I don't want to do 21, 50, and 200. I want to do whatever. Okay. And remember, when it's in that tighter time frame, that smaller time frame, it's not a 200-day moving average. It's on a 1-minute chart. Then it is a 200-minute moving average. And then, of course, 50 and 21 minutes versus days. So I think it could be worth maybe exploring to tweak it a little bit more. Now, if you have maybe an intraday rule that you use if you're doing something similar like this with the SPX or other entity, feel free to chat it in. It could be something that we could consider, could be something that we could test over the next week. And so the question is, are we going to stay put with those rules? I think they warrant more practice trading. I think it warrants more examples. Because not all days are really bullish, right? We've had the last, a few days this week have been quite bullish. Market's not always like that. It could be up one day, down the next, up one day, down the next. And so I think we need a little bit more testing these initial rules and then testing this idea of maybe doing a 5-day, 5-minute chart with some other moving averages to tell us during the day if it warrants putting on another bullish trade. All right. PJ Shannon says, I want to have to look into how to create groups like that for my different trades. It's really easy to do. I'll just show you quickly. I've also done a video on it, which I can put in the links in the notes for our show notes when we're finished. But let's just take this trade that we're in right now. I could do a right mouse click on it and I could say move to group. Suppose you haven't created any groups yet. Then you just click on add group and then you create whatever you want that group name to be called, put it in, and then it starts putting your trades there. And then when you go to enter a trade, then you can have it go to that grouping right from the get-go, or afterwards you can move it. Just kind of like right here, I was pretending I was going to move it, but didn't really. That's how you would do that. Okay. Deegan Viking says Iron Condor. I mean, for 0 days to options expiration. There might be situations that might warrant that. I think the best approach initially is to start out with the trend. Is it trending bullish? Is it trending bearish? And but you could certainly test it in your paper account for Iron Condor and put on both sides, right? The bearish call spread, the bullish call spread, or the bearish call spread, bullish put spread. That's what I meant to say there. All right, let me see. Momo says, if this is not the correct ask for this class, but can these strategies be used for short dated or more like zero DTE trades? That's what you would want to test. That's what you would want to test out in your paper money account. See if it makes sense. See if you'll like it, or if you want to be tweaking a little bit. And today we're gonna continue to test and we're gonna tweak. We're gonna do a little bit of both. Now, what we're gonna do, we still have our trade on here. It's kind of just flat right now. It hasn't really decayed a whole lot. We're gonna hold it overnight, and we have a stop in place. We have a target, right? 50% of the max gain to get out as well. Okay, so we're just going to let it play out. I'll tell you about it next week when we get together. So if this is something you're interested in, I'm going to encourage you to paper trade it and see what seems to work for you. If you don't like these rules, you don't have to use them, right? Nobody says you have to use them. You might have your own idea. You might have your own indicator that you might want to use. Now, I do hope all of you have become subscribers to our Trader Talks channel. Makes it so much easier to find our content, right? We're in our trading index options right now. Scott Thompson's going to be up next at the top of the hour with stock investing for beginners. All right. Again, appreciate your feedback on that survey. If you'd fill that out for us, we always appreciate that. If it was helpful for you today, go ahead and hit the thumbs up on the way out. But I appreciate your time and attention here today. We'll continue to fine tune our rules here next week. Bye-bye.